Stock market returns are never guaranteed. Research and deep analysis only gives an edge in the market, but risk management cannot be ignored. Welcome back to DK Global Market Insights. Today we are doing a follow-up deep dive into Hang Seng Index 2025. Looking at the performance so far this year, the sector drivers, valuations, growth forecasts, and finally our updated outlook for rest of 2025. Remember, this is an educational content only. We do not provide any buy or sell recommendation. Let's get started. Current Hang Seng snapshot. Data doesn't lie. In the last 1 year, the Hang Seng market as a whole is up around 43%, which is a very strong rebound after years of underperformance. But when we dig deeper, the real story in the sector-wise breakdown, tech has gained 113%, healthcare is up 108%, materials about 62%, and consumer staples more than 54%. Meanwhile, sectors like utilities, energy barely moved. They are at 7% and 1% respectively. This implies that the rally is not broad-based across all sectors. Instead, it is being led by growth-heavy and policy-supported areas like technology and healthcare, while the traditional defensives have lagged. From macro view, this is tied closely to China's efforts to stabilize the economy, attract capital inflows, and support innovation-driven industries. Unpacking the drivers, headwinds, and tailwinds. Now, what is actually driving these moves? Let us start with the tailwinds first. First, the policy support. Beijing has been offering incentives to tech, AI, biotech, and clean energy sectors, boosting investors' confidence. Second, corporate earnings recovery in technology and healthcare after a long slump. And third, global liquidity conditions. Even though interest rates are high globally, expectation of cuts later in 2025 have helped risk appetite. On the other hand, we cannot ignore the headwinds. Geopolitical tensions around US-China trade and technology restrictions continue to weigh on sentiment. Regulatory uncertainty, especially in the internet and healthcare-related firms, still creates volatility. And lastly, the domestic slowdown in China, property markets weakness, and slower consumption is a drag. So the Hang Seng is riding a strong positive momentum, but risk remain around the policy shifts and global macro. Current valuations. Now let us talk about the valuations of the index. The overall Hang Seng market, I'm talking about the broader market, trades at PE of about 14.7 times compared to its 3 to 10 years average of 11 to 12 times. So it is slightly more expensive than usual, but not extreme. By sector, healthcare is the most stressed at 71 P ratio, but analysts expects 32% annual growth over the next 5 years. Tech is also pricely at 52x PE with 26% earning growth forecast. Consumer names like staples, 28 times PE, 17% growth, and discretionary 22 times PE, 18% growth are the mid-range. On cheaper side, financials trade at just 8.6 times price to earning multiple, but growth is expected to be only 4%. Real estate actually shows negative earnings, hence negative P, but the analysts still project 25% growth, which may be too optimistic given the structural property challenges. So the picture is clear. Growth sectors are expensive, but earning forecasts justify part of that. Traditional sectors, although look cheap, but the growth outlook is quite weak. Hang Seng 2025 updated outlook. Now, what does all this mean for the outlook? Given the strong rebound already seen plus 43% in 1 year, the Hang Seng may not repeat the same kind of explosive returns in the remaining parts of 2025. Instead, what we can expect is more sector rotation where the investors may shift from overheated tech and healthcare into undervalued financials or industrials. Volatility around the policy announcements, especially related to property support and US-China relations. A more range-bound index movement with the possible resistance at higher levels, the support near the long-term moving averages could play a game. Our base case is that Hang Seng could still deliver mid to high single-digit returns by the year end, but investors should be ready for consolidation after such a sharp rally. Strategic plays for investors looking at Hang Seng exposure, here are some key takeaways. Focus on quality. Not every technology or healthcare stock will meet high growth expectation. Stick to strong balance sheets and proven business models. Diversify. Don't just chase the hottest sectors. Consider mixing growth with value. For example, pairing tech exposure with financials or industrials. Stay alert to policy news. In China, regulations can change very quickly and entire sectors can swing overnight. And most importantly, stay adaptable. This market will continue to move with both global and domestic headlines, so review positions quite regularly. Technical analysis. Now let us move straight away to price chart and perform the multiple time frame technical analysis to understand the price action, to understand the support and resistance level. We will also do the relative strength analysis versus S&P 500 index. This is the monthly price chart of Hang Seng Index. There is a very interesting price action on this price chart. Listen me very clearly and watch it what I explain. We will first discuss the historical price action. See the support here that started way back in December 1992. Price took support over here during correction. Once again, price took support on this trend line in August 1998. Then once again the correction took place, and here what the price did, it again took support on the trend line in April 2003. In between, there was a formation of the double top, but the apex was here. Price defended it, and again there was a rally. What has happened again? Then again there is a dip in the market during the bear market of 2008, and the price again took support in October 2008. Again, if you see the price action, it defended this trend line once again in February 2016. Again, it defended the price in March 2020. Recall, it was a bear market during COVID time. And finally, there was a decisive breakdown of this trend line when in November 2021, and there was a sharp fall in the price of Hang Seng Index. Index become quite weaker. So, technically speaking, this trend line was very, very significant, and it was acting for a very, very long time as a support. Now, after the downtrending move, the market structure was lower highs and lower lows. It made a double bottom kind of formation, which means it stopped making lower lows kind of market structure. This was the apex area. There was a breakout of the double bottom, indicating the breakout of the reversal chart pattern, that is double bottom. Now, what has happened? During the course of this move, in the recent upside move, this was the counter trend line, was acting as a resistance, once again resistance. Now in the current month, price is trading above this trend line, which is a significant price action. So where is the neckline? This is the neckline area. So 21,900 becomes the very strong support in Hang Seng Index, especially when you see multiple moving averages above this neckline area of double bottom, there is an existence of SMA 200, SMA 233 and SMA 144. So this was a very significant move. Where is the supply area? Supply area could be this area where the price got rejected, and this is the price area where the price got rejected. Not now, but even earlier too, there was a rejection, there was a rejection. So these two horizontal lines will act as a supply area, and most importantly, there is a intervention of this rising trend line which was earlier acting as a support, and after the breakdown it will act as a resistance. Now the question here arises is, will Nasdaq give a breakout of rounding pattern? We do not know. Nobody can predict the market, but the fact is the price action is very significantly important because it has given a breakout of this counter trend line in this month. Look at this weekly price chart. There was a downtrending move. Price took support here, which was earlier support area, and now the market structure is higher highs and higher lows kind of structure. Each time the correction is taking place, price is taking support at EMA 55. Now there is a continuation chart pattern which we call it as a cup and handle kind of chart pattern, which has already given a breakout. This is the daily price chart. Clear-cut uptrending move. Even the slopes of all long-term moving averages like SMA 144, SMA 200 and SMA 233 all are inclining up, showing the strong upside move in Hang Seng Index. These are the two short-term moving averages, that is EMA 21 and EMA 55, and EMA 21 is placed above EMA 55. So even short-term trend is looking bullish. Now let us do the RS analysis with respect to S&P 500. This is the lookup period 50-day. You can see the RS chart. Here it outperformed the S&P 500. So there is a little underperformance during this period. Once again, it has started outperforming S&P 500 index. Conclusion. The Hang Seng has staged a powerful comeback in 2025, led by technology sector and healthcare. Valuations are no longer cheap, but the growth expectations remain strong in certain areas of the market. The big question now is sustainability. Will this rally broaden out to other sectors or cool down as the valuations stretch? Either way, continuous monitoring, sector selection, and risk management will be the key to navigate this market. Learning never stops with DK SINHA, and I'll see you in the next video.